In Chapter 7, we will be looking at auditing the internal controls over financial reporting. We have quite a few learning objectives to go through. If you look on page 220, you will see there's 18 of them. So we will plow through each one. Our first one is understanding management's responsibilities for reporting on internal controls under Section 404 of Sarbanes-Oxley. Now, if you recall, Sarbanes-Oxley's impacted auditors of public companies significantly. Specifically, Section 404 of the Act requires, not maybe, requires managements of publicly traded companies, those issued and traded on a stock exchange, to issue a report. So management must issue a report where they accept responsibility for establishing and maintaining adequate internal control over financial reporting, which of course we have an acronym for ICFR, Internal Control over Financial Reporting. And they must assert in this report whether ICFR is effective as of the end of the year. Now, in our last two chapters, we looked at, our last chapter, we looked at internal control in detail. Now we're going to look at that audit part of it. So, what does management state? Well, they must comply with the following requirements in order for the external auditor to complete an audit. They accept responsibility for the effectiveness of the internal control. They evaluate the effectiveness using suitable control criteria. They support the evaluation with sufficient evidence, including documentation, and the management provides a written assessment regarding the effectiveness of the entity's internal control as of the end of the entity's most recent fiscal year. So these are all on the responsibility of the company. Excuse me one second. Multitasking here. Okay. Auditor's responsibilities. So what does the auditor have to do? It is the independent auditor who must audit and report on the effectiveness of the internal control on financial reporting. So they don't create it. They don't make sure everybody's doing their job. They report on the effectiveness of it. They audit it, right? And it's required to be conducted as part of an integrated audit. So the internal controls on financial reporting and the financial statements themselves is an integrated audit. Here we're focusing on how does the auditor audit and assess the internal controls for financial reporting. Now, what is internal control for financial reporting? It's defined as a process designed to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements in accordance with GAAP. So it's everything that allows that to happen. Specific controls include those that pertain to the maintenance of records that accurately and fairly reflect the transactions and dispositions of the assets of the company. So what procedures are in place to be sure of that? Provide reasonable assurance that transactions are properly authorized and recorded in accordance with GAAP. So a internal control over financial reporting system will do that. And they will provide reasonable assurance regarding prevention or timely detection of unauthorized acquisitions, use, or disposition of the company's assets. So it's what's in place to ensure these three things. Now, an internal control deficiency. This exists when the design, so how it's created, or the operation, the actual working of it, of a control, does not allow management or employees, in the normal course of performing their assigned functions, to prevent or detect misstatements on a timely basis. Okay, so if you look in your book on page 223, so this is a control deficiency. A design deficiency exists. So it's a design or operation deficiency. What is a design deficiency? It exists when a control necessary to meet a control objective is missing, or it's not properly designed. A deficiency in operation exists when the control does not operate as designed, or the person performing the control doesn't possess the authority or qualifications to perform it. So one is in the design of it, the other is in the actual operation of it. Control deficiency. Now, a significant deficiency is a control deficiency or a combination of control deficiencies, so more than one, that is less severe than a material weakness, yet important enough to merit attention by those responsible for oversight of the financial reporting of the company. So, how do you know that? It's all based on professional judgment, guys. So if you're, like I said before, if you think you're walking away from this class going, I'm going to audit my first day out and I'm going to do a whole audit by myself, you are wrong. You have to start at the bottom and learn these things. We're just telling you the tools, giving you the tools. Now, a control deficiency may be serious enough that it is to be considered not only a significant deficiency, but also a material weakness. That's bad. A material weakness is a deficiency or combo such that it will cause, or there's reasonable possibility that a material misstatement of the financial statements will not be prevented or detected by that control or the lack thereof. So we're going to illustrate this on the next slide. The auditor must consider two dimensions of the control deficiency: the likelihood, reasonably possible, it will cause it, and the magnitude. Will it be material, significant, or insignificant? So let's take a look at this. This is on page 224. In determining if you have a control deficiency, a significant deficiency, or a material weakness, the likelihood, the control deficiency, the likelihood that it is remote to reasonably possible or probable is one level. And then is it a material? Is it a large? Will it cause a large problem? Not material, but it is significant. It's something we need to say. So the magnitude of the deficiency, and not material or significant. So if it's remote, okay, we kind of ignore it. If it's anything other than remote, see, you can see remote is in that like dotted box area. So if you went right up, straight up from the box, there's nothing in those. But on the right side, where it's reasonably possible or probable, now this is when we have to worry. The likelihood of the control deficiency. If it's not material or significant, we report it to management, have it corrected. If it's not material but significant, so it's not going to create a material misstatement on the financial statements, but there is an issue. That's a significant deficiency. This should be brought to the attention of the audit committee and management. If it is material, meaning it will cause a material misstatement on the annual or annual financial statements, and it's reasonably possible or probable to occur, then we must report it externally on our report and to the audit committee and to management. So it all depends on the level of magnitude and likelihood, how a deficiency will be reported. Now, So that's kind of what the auditor's looking at there. Let's go through management again. Management's assessment process. They must follow a top-down, risk-based approach. And on page 225, it states the SEC issues guidance for evaluating and assessing the internal control over financial reporting. So they're not on their own. The SEC is letting them know, here's what you need to be looking at. And here they are. You must identify financial reporting risks and controls. That's number one. So management must look at things like, take a look on the bottom of page 225 in table 7.1. They're looking at controls within the control environment. What's the tone at our top? The assignment of authority and responsibilities, policies and procedures, how they're being applied, the entity-wide programs, what kind of codes of conduct and fraud prevention. We need to assess that as managers of the company. Controls over management overrides. Are there any? How easy is it for management to override issues? The entity's risk assessment process. Are they going through that and addressing those risks that could prevent the company from meeting their objectives? Centralized processing and controls, including shared service environments. For instance, when I worked at the New York Times, we had a shared service. WNEP never wrote a check, and we never collected any cash in our accounting department. We billed, and we authorized payments and things like that, and we had contracts. We had payroll, but and we didn't process the payroll at WNEP and print the checks out. Actually, the New York Times had a shared service area, and what that was a location separate from WNEP. Actually, I think it was in Norfolk, Virginia, and they paid all the bills that were authorized. They created the paychecks and just, made sure payroll was done properly. And we actually used a lockbox system at our bank to collect cash. So that's the kind of environment we're talking about. Does the company use one area to do some of this processing? So there's no controls for those items in the maybe the division level, but at the corporate level. Controls to monitor results of operations. Are there controls to monitor other controls, including activities of internal audit function, the audit committee? Controls over period end processing reports. What's in place to prevent material misstatement there? Policies that address significant business control and risk management practices. So these are the areas that management must first look at, report about, and what kind of related controls are in place. So most entities, and before I go on to this next part, is staying with consider a location. And this is looked at in more depth later on. Many companies have different locations. So do we look at all the locations? Do we pick a location? And so they'll discuss in detail how an auditor goes about doing that. And then evaluate the evidence, or the company would do that, I should say. Evaluate the evidence about the operating effectiveness. Is management doing that? So are they supporting themselves with evidence? Okay. Some internal control tests that management, internal auditors would do. Controls over initiating, authorizing, recording, processing, reporting significant accountant disclosures, controls over the selection and application of accounting policies in conformity with GAAP. What kind of anti-fraud programs and controls are in place? What kind of IT general controls are in place? And what kind of controls are over non-routine and non-systematic transactions? Okay, so these are the typical types of controls that may be tested, and management would have them tested. And then, of course, management's documentation. Now, COSO the framework that is used by management. So this framework identifies three primary objectives of internal control. So when they're developing and designing their internal controls, they're like, why are we doing it? To provide reliable financial reporting, we have efficiency and effectiveness in our operations, and we're compliance with laws and regulations. So that's always what they're looking back to as they develop that internal control. So we talked about this, examples of entity level controls that are created based on that information from COSO. Again, management must develop sufficient documentation to support its assessment of how well internal control is doing. The documentation may take many forms. It could be paper, files, media, policy manuals, process models, flowcharts, job descriptions, documents, and forms. So the point is that management is documenting the internal control, and they're actively assessing it. Now, when the auditor is now looking and planning for the audit, we have to remember an audit is an integrated audit now. It's composed of audits of internal control and the financial statements. The control tests determine how much substantive procedures need to be completed. We've talked about this already. The results of the substantive procedures are considered in the overall evaluation of internal control, so they rely on one another. So when we're starting to develop our plan for performing an audit, we plan the audit, of course, for the internal control over financial reporting, identify tests to look at the controls, and identify the controls we would like to test, evaluate the design, and test the operating effectiveness of selected controls, then evaluate how well they are effective, how effective they are, I should say, and then form an opinion on the effectiveness. So that's the flow chart. That's what the auditor is looking. That's the big picture. Now, planning the audit. Planning process is similar to the process used for the audit of financial statements. We look at the role of risk assessment and the risk of fraud in the internal control, scaling the audit, and using the work of others. Before we go into using the work of others, I want to direct your attention to page 230. A major part of risk assessment is assessing the risk of fraud. So as an auditor, we are responsible for evaluating the risk of material misstatement due to fraud and also the risk of management override of controls. So there's a couple bullet points there. We need to assess and use our professional judgment in looking at controls over significant unusual transactions. So what's in place to prevent fraud or management override? Controls over journal entries and adjustments made in the period end financial reporting process. Who made them? Who authorizes them? Controls over related party transactions. Controls related to significant management estimates. Controls that mitigate incentives for and pressures on management to falsify or inappropriately manage financial results. So what processes are in place in those kind of areas to prevent material misstatement or fraud and prevent management override? So as an auditor, during our planning, we're looking at this. We're scaling the audit. How much it depends on the size and complexity of the company. And then finally, we're looking at how we should use the work of others. So this is a major consideration because so many people outsource now. And or even how should we use the work developed by the company? So the auditor may use the work of others when the auditor should evaluate the nature of the controls subjected to the work of others, look at the competence and objectivity of that individual, and test some of the work performed by others to evaluate the quality and effectiveness of their work. Now, as the risk associated with internal control increases, then we shouldn't rely as much on others' work. And that just makes sense. We want to be comfortable with our evaluation. So, the next step after we plan, we want to identify controls to test. So we're going to identify the entity level controls. Then we'll identify any significant accounts and disclosures and their relevant assertions, understand the likely sources of misstatement, and then select controls to test them. That's the process we go through. Now, there are 2 entity level controls required for specific evaluation by the auditor: the control environment and the period and financial reporting process. We've talked about the control environment. You could read through that again. But in the second part, the period and financial reporting process, this is important. The period end process controls include procedures used to enter transaction totals into the general ledger, how they select and apply accounting policies to initiate, authorize, record, and process period end journal entries, like adjusting journal entries. How they record recurring and non-recurring adjustments and prepare the financial statements themselves. So this is a very important part. They also identify significant accounts, the size and the composition, susceptibility to misstatement due to errors or fraud. So what kind of controls are over them? Is the risk high or low? The volume of activity, complexity and homogeneity of the individual transactions processed through the account or reflected, that will determine the risk factors. Nature of the account or disclosure, accounting and reporting complexities associated with that account. So these are all things we're looking at. Exposure to losses in the account, the possibility of significant contingent liabilities arising from the activity, any related party transactions in relation to that account, changes from the prior period in that account, this period. So we're identifying significant accounts and disclosures and their assertions in this part of the process. So first we identify entity level controls we need to look at. Then we identify by going through something like that kind of list to determine the significant accounts that need to be looked at. Then we're looking for and understanding likely sources of misstatement. We need to understand the flow of transactions. We need to identify the points within the entity's process in which a misstatement could arise that would be material. Is there anywhere during that process? We need to identify the controls that management has implemented to address these potential misstatements. Is there a risk or not as much of a risk of a material misstatement? We need to identify the controls that management has implemented over the prevention or timely detection of unauthorized acquisition, use, or disposition of the assets that can material misstate the financial statements. What does it all come back to, guys? Right? Will this risk cause a material misstatement in the financial statements? And depending on the likelihood and the magnitude, that will answer our question. So usually, before we go into the next part, understanding the likelihood of a misstatement would be best determined by doing walkthroughs, and that's probably the most normal or ordinary way that This is determined, and at this point when you do a walkthrough, you can inquire and talk to people and see the process from start to end, and then it's easier and you're better able to see where in the process there's a risk for material misstatement. Once you've identified your entity level controls, found your significant accounts and disclosures, understand where misstatement may occur, now you can select what you want to test. Factors commonly considered when identifying controls to test. Did you find any points at which errors or fraud could occur? You may want to test that. The nature of the control implemented by management. The significance of a control in achieving the objective. Is it an important control? The risk that a control may not be operating effectively. Some factors that affect whether the control may not be operating effectively include: have there been changes in the volume or nature of the transaction? Have there been changes in the design of the control itself? Are we relying on the effectiveness of other controls? Key personnel changes. Are we relying on an individual or computer? And the complexity of the control. So depending on those kind of factors will help us to determine what controls we want to be tested. Then we test them. And we will look at that through the rest of this chapter. How do we test controls? Different specific areas. So we're still in a general mode here. So we evaluate the design, test and evaluate the operating effectiveness in terms of inquiry, inspection of documents, observation, and reperformance. So that's the nature of testing. Those are the typical ways that we test our internal controls. And inquiry is a lot of it. Okay, but in the end, the type of control is based on the nature, the type of control affects the nature of control testing. And I'm reading right out of the book on page 235. If you have a manual process versus an automated process, which can you trust more? And you'll test them differently. The timing. Do we do it at an interim date versus an as of date? And that depends on the nature of the item, again. And then finally, extent. The nature of the control is one item. Manual control should be subjected to more extensive testing than automated, just because of the nature of it. How often does it occur? The more frequent a manual control operates, the greater the number of operations that should be tested. And the importance of the control. The more important, the more extensively it should be tested. So we're looking at those items in determining our tests of controls. Once we've tested, now we evaluate. The auditor must consider the likelihood and magnitude of a control deficiency. We've stated that already. That was our picture in the beginning of the chapter. The risk factors that affect the likelihood that a control deficiency. So during our evaluation process, that's what we're looking at. What is the likelihood that this control deficiency will result in a misstatement of an account balance or disclosure? So the nature of the financial statement must be looked at and its assertion. The susceptibility of the related asset or liability to loss or fraud. So based on the test of controls, we need to think about that. The subjectivity, complexity, or extent of judgment required to determine the amount involved. That could really cause a material misstatement. I always think of allowance for doubtful accounts. If someone that is a judgment call. It's very subjective. So the test of controls for determining that account, to me, it's manual. There's a lot of subjectivity involved. And, based on it, is it important? That is what we're talking about here. If you have that account, if it's off, is it a material amount? Will it be materially misstate the financial statements? The interaction or relationship of the control with other controls. The interaction of the deficiencies, if you have more than one. And the future consequences of the deficiencies. All of these things must be looked at to determine. These are risk factors that will determine if our deficiency will cause a material misstatement. If a deficiency or combination of it prevents the auditor from having reasonable assurance that transactions are recorded properly, then the auditor should treat the deficiency as a material weakness. And we know material weakness bad, right? So, page 237, table 7-7, the indicators of material weakness. And here they are on a slide. There's fraud, identification of fraud, whether or not material, committed by senior management. That's an indicator of material weakness. I think so. Restatement of previously issued financial statements to reflect the correction of a material misstatement. So there's risk of more material misstatement. Identification by the auditor of a material misstatement of financial statements in the current period in circumstances that indicate the misstatement would not have been detected by the entity's internal control. So internal control would not have found that. And ineffective oversight by the entity's external financial reporting and by the entity's audit committee. So these kind of circumstances will indicate material weakness, and this is stuff that must be reported to the public. Now, what if we find material weakness? Well, there's remediation. I mean, it's just no, the company's no good and it's done. No, remediation is a process of correcting a material weakness in your internal control. Now, if a material weakness is corrected before the as of date, so the financial statement date, there must be sufficient time for both management and the auditor to test the operating effectiveness of the control. If not, an adverse opinion is still issued. So I would like you to make sure you go through scenarios 1 and 2 on pages 237 through 239. Okay, and a great example of an auditor's test of daily information technology in the blue box, Exhibit 7-3. Okay, but when an auditor is testing controls, remember, it's just not happening as of December 31st. They're testing them throughout the year. So if they find a material weakness, a deficiency that is considered a material weakness, if remediation occurs and they're able to test it and feel it was fixed, then we can change our opinion about it. And that's what we're going to talk about in a second. Now, written representations. In addition to management representations obtained as part of a financial statement auditor, it also obtains written representations from management related to the audit of internal control financial reporting. Failure to obtain this, including management's refusal, is a limitation on the scope of an audit and is sufficient to preclude an unqualified opinion or a clean report about the audit of the company. On the bottom of page 239 are the representations made by management to the auditor. They're responsible for establishing and maintaining effective internal controls. They've performed an evaluation and assessment of them. Management did not rely on work performed by the auditor in forming its assessment. It made its own independent assessment. The conclusion about the effectiveness of the internal control based on the control criteria is as of a specified date. It's disclosed to the auditor all deficiencies it's found. Descriptions of any material fraud and other fraud, although not material, involve senior management or other employees who have a significant role in the entities have also been identified. Control deficiencies identified have been communicated to the audit committee during previous engagements, have or have not been resolved, and descriptions of any changes in internal controls, including corrective actions taken to remedy significant deficiencies and material weaknesses. So remember, management is always assessing this, and it is their responsibility to do that. Now, in auditors' documentations, what are we required to keep track of? Well, as part of the PCOB, the auditor should document the processes, procedures, judgments, and results relating to an internal control. When an entity has effective internal control, the auditor should be able to perform sufficient testing of controls to assess control risk for all relevant assertions at a low level. The auditor's documentation of the process, procedures, judgments should include the understanding and evaluation of the design of each of the components of internal control, the process used to determine the points at which misstatement could occur. Remember, right after we planned, we did this assessment. The extent to which you relied on the work of others, how much the scope of testing, and the evaluation of any deficiencies discovered or findings which could result in a report modification. So all of this process must be documented by the auditors, and that's specifically the items that must be included. Once an auditor has completed this part of the process, they are now ready to create a report on the internal controls. An unqualified opinion signifies that the internal control is designed and operating effectively. There's no material weakness. A serious, more than minor scope limitation requires the auditor to disclaim, and that basically means they can't provide an opinion. Okay? Or they should withdraw from the engagement. And an adverse opinion is a very bad opinion and is required if a material weakness is identified. Okay, now what's very interesting, and if you look on the second paragraph underneath adverse, it is possible for the auditor to issue an adverse opinion on internal control while at the same time issuing an unqualified opinion on the financial statements. So such a conclusion is reached when the internal control is not effective at preventing or detecting material errors, but the auditor concludes that the entity's financial statements do not contain material misstatement. How could they do that? They do other testing. They don't rely on the internal control and do those other substantive tests. Okay, so again, a control deficiency or even a significant deficiency, unqualified opinion, but a material weakness, adverse opinion. And on page 242 is an example of a separate report for an unqualified opinion. And on 243, a combined report expressing an unqualified opinion on financial statements and internal controls. So it could be presented in one of two ways. Read through those, make sure you understand them. You have an intro paragraph, a scope paragraph, a definition, inherent, opinion, and explanatory. You want to be familiar, very, very familiar with these reports. I know when I was taking the CPA exam, you used to have to memorize them. We're not at that level anymore, but you should be that familiar with them. Now, a minor effect on the seriousness of scope limitation, it's an unqualified opinion, but more than minor effect, you could disclaim or withdraw. So you're not able to come to a conclusion because you don't have access to information or something. Other reporting issues we need to be concerned about. Management's report is incomplete or improperly presented. The auditor decides to refer to the report of other auditors. Significant subsequent event has occurred. So these are on page 244 to 245. What do? Okay. In Chapter 18, we'll be talking more about the reports provided by an audit. Okay. Now, management's report incomplete or improperly presented. So, if an auditor determines that elements of management's annual report on internal controls are incomplete, they need to modify their own audit report to reflect that. If we rely on report of other auditors, we would need to refer to that other auditor in your report. Subsequent events also need to be handled. We'll be talking more about those in Chapter 17. So these are events that happen after the balance sheet date but before the audit report is prepared. So that could affect our opinion. There's additional information contained in management's report on internal control. For example, management may include disclosures about corrective actions taken by the entity, the entity's plan to implement new controls, or a statement that management believes the cost of correcting a material weakness would exceed the benefits. Oh, if that's the case, the auditor should disclaim an opinion on such information and include the following language as a last paragraph of the report. And this is important. We do not express an opinion or any other form of assurance on management's statement referring to the costs and related benefits of implementing new controls. And there is a remediated material weakness at an interim date, so you want to address that in your auditor's report. So these are just additional issues that could affect our audit report on internal control. Additional required communication. The auditor must communicate in writing to management and the audit committee all significant deficiencies and material weaknesses identified during the audit. It's required. It's an auditing standard. This communication should be made prior to the issuance of the auditor's report on internal control. In addition, the auditor should communicate to management in writing all control deficiencies identified during the audit and inform the audit committee when such a communication has been made. Okay, so this is very important, and it's part of our requirements under an auditing standard. Okay, so before we go into the advanced modules 1 and 2, just to reiterate, we got through almost all of those learning objectives right there. And this is a great chapter on how we proceed and what we're required to do in order to create an internal a report, an audit report on internal control. So we've looked at and gained an understanding of management's responsibility for reporting under Section 404 of SOX. We looked at the auditor's responsibility for reporting on internal controls, the definition of internal control over financial reporting. What's the difference between a control deficiency, a significant deficiency, and a material weakness? Remember that picture. Management's process for assessing internal control. We know how auditors conduct an audit. We understand how they plan, be able to describe the top-down risk-based approach that auditors use to identify controls to test. We understand how to test the design and operating effectiveness of controls. We understand how to evaluate identified control deficiencies and remediation effects and how they affect our auditing report. We know the written representations that the auditor must obtain from management and our document requirements. We understand auditor reporting for the audit of internal control and the communication we're responsible to make about it. Okay, so now we're going to wrap up with looking at the use of service organizations and finally computer-assisted audit techniques, which you've already done. So many companies use service organizations to process transactions. If the service organization services make up a part of a company's information system, then it is considered part of the information and communication component of the internal control. Thus, management and the auditor must consider the activities of the service organization and report on them. So management and auditor should perform the following with respect to the activities performed by this company. We need to obtain an understanding of the nature and significance of the services provided by the service organization and their effect of the user entity's internal control relevant to the audit. Sufficient to identify and assess the risk of material misstatement and design and perform audit procedures responsive to those risks. Safeguarding of assets is defined as policies and procedures that provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use, or disposition of the entity's assets that could have a material effect on the financial statements. So one special consideration for an audit is how we use service organizations or the company we're auditing. The other is how do they protect their assets. And that's a very important component of our internal controls. Another area that's important is the computer-assisted audit techniques. Now, many companies, many public accounting firms use audit software to help complete some of the testing that is required. You are already using a generalized audit software. So IDEA is just that, general audit software. And it's used to do a couple things. It's easy to use. Some of you may argue with me on that. You have limited IT expertise or programming skills are required. And the time required to develop the application is usually short. And you can look at an entire population. So you don't need to sample. Some disadvantages: it involves auditing after the entity has processed the data rather than while they are. It has limited ability to verify programming logic, and it is limited to audit procedures that can be conducted on a data in electronic form. So the practice you're getting with IDEA, though, is experience with generalized audit software. And you've seen that already, where we've been looking for, accounts receivables over a certain dollar amount or below a certain dollar amount, or those occurring after a certain date. Very quickly, we were able to collect that data. Custom audit software is generally written by the auditors for the specific audit test. So it may be required when the entity's computer system isn't capable or compatible with our GAS, our generalized audit software. It's expensive to develop. It could take a long time to develop and may require extensive modifications. But in the end, it may be more cost benefit to do that. And then finally, test data. Test data are developed by the auditor to test the application controls in the entity's computer programs. The technique can be used to check data validation controls and error detection routines, processing logic controls, arithmetic calculations, and the inclusion of transactions in records, files, and reports. So we put them through as test data. Let's see if the computer system catches that. Let's see if it's doing what it's supposed to be doing. So this provides us direct evidence of the effectiveness of the controls. So first, it can be very time-consuming as a disadvantage. And second, the auditor may not be certain that all relevant conditions or controls are tested. Okay, so they all have their advantages and disadvantages. GAS being that general audit software, custom audit software that the auditor develops, and then test data to help identify and look at the software to see if it's actually processing the way it's supposed to. And there's some functions performed by generalized audit software, which we've already seen. We've been using databases, selection operators, so select from files or database transactions that meet certain criteria. We did that using formulas. We could add, subtract, and do all kind of formulas on transactions, files, and databases. Provide functions supporting various types of audit sampling for statistical analysis and report generation. So it gets done much quicker than it would have been done manually.